My name is Moenga Elvis. I work with ICPAK. ICPAK is the Institute of Certified Public Accountants of Kenya. And the primary reason why I'm seated here today is because we are asking you, as REIT issuers, to adopt certain standards that have already been mentioned in IFRS S1 and S2. And hopefully I can help to shed some light on the expectations from a reporting perspective. Happy to be here. Lumumba, over to you.
Thank you. Thank you very much. Good afternoon. My name is Andrew Lumumba. It's a pleasure to be here. With background, so I'm a trained civil engineer, but I found my way in finance, and I'm here to tell you why you've not gotten the money you want and how you can get it.
Good afternoon. My name is Josephine Kimanzi from Nairobi Securities Exchange, in charge of the Sustainable Finance Center of Excellence. Today I'm here to let you know of the opportunity there is to unlock financing through the different products that we have within the capital markets, the incentives that there are, and potentially how we can unpack some of the gaps that we're seeing in our market, how we can engage policymakers, and probably enhance the conversation that has been ongoing under that program for the last 1 year. We are here also to receive your feedback on how we can enhance that program to meet the gaps that as the market players you're currently facing. Happy to be here and happy to engage further after the panel.
Good afternoon. My name is Caroline Degwa. I'm happy to hear there's a fellow civil engineer in the panel. I didn't know. I'm also a trained civil engineer, but I found my way up here in sustainability. That's a long story. And I'm a sustainability consultant at Ernst & Young. And today I'm here to tell you that you as REITs professionals, it's possible to integrate ESG in your portfolio or in your assets, and it will inform how it can inform your income statement and your balance sheet. So thank you.
Okay, thank you very much. And so as you can see, very distinguished panel. I have resisted the impulse to call them a Gen Z panel. So let's just start off, and I'm going to ask, my first questions are going to be directed at Caroline. Caroline, this is for you. Now, we all agree that ESG has moved from a reputational issue, it is now an investment issue. So, in the REIT context, what does ESG integration actually look like? Apart from just saying it, what does it actually look like in practice? Okay? And how do investors look at when a building describes itself as green, what exactly is an investor looking at in that context?
Thank you, first of all, for that statement that ESG has moved from a rebranding statement to something else. And I think we all know we may be confusing from CSR to ESG and not to sustainability. What is actually the difference? Traditionally, we're used to CSR, where a company will just do something voluntarily, no regulation, no framework, no stakeholder expectation. They just do it out of goodwill, and you just do a charitable activity based on the community in which you operate on. But now, we move to the bigger vision, which is sustainability. But sustainability comes with a lot of initiatives. But how do we measure these initiatives? That's how the E, S, and the G came in. So the ESG is now the framework to measure your sustainability practices, but in the 3 aspects of E, S, and G. When you come to REITs, in a REITs portfolio, I imagine the assets are the properties, and I imagine the investors are talking about green building, we want to invest in green building, but what is actually green? And the biggest question that we face from REITs professionals is, these green initiatives, you're telling us to install solar panels, to move away from the grid electricity to renewable energy, to retrofit our lighting in the building. They are capital intensive. at the start. But how do we reap the value, or how do we reap the performance at the end of it all? So in today's, one simple word I can say, sustainability is equal to valuation uplift. That is, if it is that we all know the activities that are happening in terms of REITs portfolio or the assets, it's mainly energy, moving to renewable energy, retrofitting the building, better waste management, better green construction materials. But all I can say is that all those results to climate action, they result to CO2 avoided, or energy saved, or that amount of water that is saved. And all I can say is that one ton of CO2 that has not been emitted as a result of your sustainability initiatives, or that kilowatt of energy that has been saved as a result of you retrofitting your energy lights, or you going the renewable way with solar panels, or that green initiative that you've done is an income statement waiting to be written. It is a balance sheet waiting to be strengthened, and at the end of it all, it is a green building. So in terms of ESG, I see ESG as an investment lens that is used by investors to evaluate your performance in terms of the E, in terms of the S, and in terms of the G.
Very nice. I will come back to you later on, but I want to move on to. I will skip Josephine and move. No, is it Josephine? Yes, and move on to Andrew, because Andrew is a money guy, and in this room, it's full of people who are looking for money. Okay, and so it's nice to have all these very nice stories about efficient buildings and wastewater management and so on, right? But let's ask the very real questions, okay? When a financier is looking at a real estate portfolio, how much weight are they actually giving to these resilience factors? Is it affecting the credit appraisal, any insurance assumptions, pricing, covenants, whatever? Is there an actual effect on the financing decision?
Short answer, yes, but it can be better. Hi, can you hear me? Yes. I think, okay. So, yeah, it's not so clear. Thank you, that's a bit better. So yes, it does affect. The question is, how material is the risk to the sustainability of the project, the transaction that you're looking at? So these risks have traditionally been identified and categorized and assessed in an indirect manner, so they were not explicitly called ESG or so on and so forth, but would still be interested to know, are we saving? Are we operating as efficiently as possible? Do we have risks such as fire? Let's say we talked about tower projects. Wildfires are a risk that can be categorized as ESG. How do we mitigate those risks? Ideally, it would lead to either higher pricing, shorter tenors, strict covenants, and sometimes, lack of appetite at all on specific transactions. So it has been done, but I think it can be improved now that we have better frameworks and reporting frameworks that can give investors and financiers better sight, quantifiable numbers that can be assigned to these risks.
But as a follow-up, don't put down your mic. No, as a follow-up, this money conversation is very important. Yeah. Now, so we are told climate finance is a major opportunity, and that, if you only do these things, you'll be able to unlock this opportunity. Yet, issuers, if you talk to some of the issuers in this room, they're still struggling to access this green finance. So where is the disconnect?
Very good. You're right. You put it very, very well. The money is out there, right? What's the problem? Project preparation. More often than not, the projects that I have had the opportunity to review and even discuss with some of my peers seem not to be well thought out. No offense to the people you are saying who are looking for money, but more often than not, you'd find that they have not done two things. And I think the session earlier presented what investors look for, but they can be summarized in two. There were five, but I can try to do it in two. Predictable quality cash flows, risk mitigated transactions, right? So you find developers don't put an effort to prepare these projects to the extent that risks have been assigned to the parties that are best suited to take them up, or they have actually sorted out the economics on their project. That's the main issue. If you sort that out, if someone gives you trouble, you can look for me.
So let's move on to reporting, and then we'll come back to the market infrastructure issues and the NSE. But let's move on to the accounting. IFRS S1 and S2. Now, we hear that these are the new standards that we must adopt. We are told that there's a timetable for entities in Kenya to adopt. I think there's a timetable for adoption of these standards, depending on whether you're public sector, private sector, large, small, whatever. Okay? For this specific audience, what does it actually mean for REITs, okay? For issuers, for the fund managers, for investors, okay? You can just break it down in an easily understandable way.
Okay. Thanks for that question, Mallowah. And maybe you can start from the point where you say this is a Gen Z panel, rightly so. I think I have two ideas somewhere in the middle. I don't know if it's looking at the books too much.
He can count his.
But one thing is for sure, and to Kokadi, by the way, but on an unrelated note, so these new standards were issued by a body called ISSB, which is International Sustainability Standards Board. And how this standard is basically organized is that we are asking entities to report on four key areas. One is on governance, basically who has oversight over sustainability-related risks and opportunities. The second one is on strategy. How are risks and opportunities from a sustainability angle affecting your business model and value chain? Then you have risk management. Have you actually integrated these things into your ERM, what we have traditionally known as ERM? And then finally, metrics and targets, which speaks to how you measure those risks and opportunities. Now, this conversation has come to light in the past few years purely because of two things. One, because boards are now talking about it, meaning it is serious. That's one. But two, somebody has asked an accountant to now quantify that story in numbers. So basically, the standards are helping entities think about if I am exposed, and for this particular audience, REITs audience, who are investing in real estate, the truth of the matter is that they are exposed to climate risks. Now, what has been traditionally happening is REITs have been reporting on some of these things like emissions, water consumption, energy consumption. Some are even EDGE certified buildings. But what these standards are attempting to do is to bridge that gap and show the financial impact of these risks and opportunities. So as late as 3-4 weeks ago, there were floods. You can bet on it that there's some real estate assets that were affected by floods. What we're asking boards to do and to think about is to start integrating climate risk into their portfolios. And we're asking them to do this at asset level. So a good example is if you have a property that is built next to a riparian land and the risk of flooding has since increased, what is the impact of that on your on your enterprise value? And here, enterprise value, we talk about your profit and loss, your balance sheet, your cash flows. We also talk about cost of capital and access to the same. So now investors are asking the hard questions. are you running your, are you really investable? The properties that you're investing in, putting money in, are they investable? And can we actually trust that our money is going to the right place? So these standards have actually come into play. And from 1st January 2027, our expectation is that REITs in Kenya will start reporting on this purely based on this framework. IFRS S1 is about the general requirements. So think about it as the general principles around reporting on sustainability. Then S2 speaks about climate-related disclosures. And here again, REITs are actually doing very well if they're already EDGE certified because they're reporting on water, emissions, energy. What is left is marrying this particular reporting requirements to the financial statements and telling a coherent story that would make an informed investor make a decision on whether to invest in property A or in property B. So essentially, Mallowah, that is the gist of this standard. It looks very daunting from the outside, but it is very doable, it's very achievable, and we cannot speak about that standard without talking about the pension funds. Because remember, at REIT level, these standards are not really very useful. Investors are the ones who are demanding for this information to decide on how they allocate capital. So REIT issuers here would be basically providers of information. So if they are providing information, the question then becomes, can we rely on the disclosures that REITs are making to inform pensioners, pension funds, and fund managers to give them money to continue doing what they do best? Yeah.
Okay, thank you for that. I have a follow-up question, but I will come back to you later, time permitting. I just wanted us to move to a related issue, the market infrastructure. We know that the Nairobi Stock Exchange has set up this Sustainable Finance Center of Excellence. This is, Josephine, this is for you. How important is this infrastructure, I mean the market infrastructure, how important is it to scaling sustainable finance for real estate? And what role does this center now play in developing standards, capabilities, credibility, confidence, you know, the whole lot?
So thank you very much for that question. Maybe as a way of introduction, the Sustainable Finance Center of Excellence was launched in 2025 in partnership with some of our development partners who are led by FSD Kenya at the moment. And the intention for that was to close a gap that we had identified in the market, being we've had one single issuance, a thematic instrument in 2019, but we were not seeing a repeat of such issuances. So what we were trying to do is, or rather what we are doing is working on closing that gap. Now, what are we doing at the moment is to close the gap on origination and structuring. Just to repeat what Andrew was saying, that we do have projects in the country, real estate projects that would fit probably within the green bond framework or green REIT frameworks, but are they bankable? Can investors actually be able to recoup their money, or even would they be interested in investing in such an instrument? So the challenge has been, we have the projects in the country, we have investors who are willing to put in their money, we have development partners who are willing to provide the technical assistance, but unfortunately the projects are not yet bankable. The other challenge that we've seen in the market that we're also trying to solve for is a structuring journey. In our market, as you know, the institutions that are charged with structuring these instruments are investment banks and the transaction advisors as well. What we're seeing is that we have very few investment banks that are actually doing the origination and that are actually doing the structuring of these instruments. So even those instruments, or rather those projects that are actually ready for financing, are not even aware that there's such a product, that they can actually unlock financing from the public markets. So that's one of the things that we're trying to solve for, origination and structuring of these instruments. Then the other two is on capacity development, both on the investor side and on the issuer side to create awareness, just like I had mentioned, so I won't repeat on that. And lastly, on the listing and the navigating the regulatory approvals journey with the Capital Markets Authority, and also something that I think has been mentioned a couple of times since morning, the issue of policy incentives or policy interventions that are required just to ensure that the journey is seamless and it's not a hurdle for issuers or projects to actually access capital. That was just an introduction on what the Center of Excellence is working to achieve. Now, in terms of the role and the importance of the market infrastructure, the NSE is a marketplace as we know it, and we're meant to convene capital and projects that require the financing. So what do? We set the rules, we set standards, disclosure checklists to support the issuers to be able to report better, and all that is meant to build trust in the market for both issuers who are on the market segments, so that they're not commingled with other issuers who are not reporting. And number two, to be able to build trust with the investors. What the market infrastructure, or rather the NSE through the Center of Excellence is working on is building issuer pipeline. One of the things that we're really keen on, and we are working on with other development partners that we've been pushing through FCDO is it possible for us to have incubation and accelerator programs or centers that are purely focused on bankability of these projects? So we would be able to bring in expertise from the different market institutions and research institutions to support these projects, in that these projects are not struggling so much to be able to access long-term public capital. And especially for first-time issuers. The other thing that we're doing is to be innovative. As you're aware, ALP is the first dollar-denominated green REIT. It's not yet green, but it's EDGE certified. And so what we did is that we were able to coordinate with the other market infrastructures, including CDSE, just to ensure that these infrastructures are speaking to themselves, or rather to each other in terms of dollar-denominated instrument. And then the last thing is to be able to develop the investor markets. One of the things that for the last 2 years we've been doing is investor engagement across the globe. And the investors that are really keen, and I'm speaking about impact investors that are really, really keen on such instruments from the European countries and Scandinavian countries. So when they come to the market, they're asking, yes, we're ready to invest in this ESG-related sort of or rather real estate, but we really need to see them on a publicly listed entity. We really need to see them on the NSE. So clearly you can tell that the market is awash with capital, both local, foreign investors were willing to put in the money. All we need is just bankable projects for us to be able to mobilize that capital. And I can assure you from the NSE, we got you. We will leave that problem of money to us.
Now, since you're speaking with so much confidence, I had a follow-up question, which I was going to ask you later, but I'm going to ask you now. And I'm sure I'm going to preempt a question from the audience. If you can you confidently state that this ESG and climate disclosure, that these things are an actual differentiator, right? That that it's not just performance, that if you do all these things, you actually see a bottom line effect, right? Is it just, are we doing it for the sake of just doing it, performing, or is there an actual differentiator, right? Does the market reward people who actually do all these things, in your experience?
I think it's
too early.
I was going to say it's a mix, because it's a bit too early, especially because we don't have enough products that we can sit here and say we've had 100 of them and this is how it's looking. But when you look at the issuers, I tend to believe that there's a demand for the issuers to actually do better when it comes to ESG reporting. When it comes to the reward of it, I think the reward will actually come later, especially where you're able to attract impact investors just because you've been able to do proper disclosures and you're following the right standards. So I think it's still a bit early on, but it's a mix. I would say it's a mix.
Okay. So let me go back to Andrew. Andrew, since you work in the guarantee space, guarantor arrangements, credit enhancement, blended finance, are these things actually adding value?
Yes, yes, they are. They are adding a lot of value. We can, call them crowdsourcing tools, finance crowdsourcing tools. Essentially, what they do is they give the ultimate financiers confidence to take that assured leap of faith, right? So sometimes, imagine someone tells you, hey, let's wade through this river. It's very shallow. And then you tell them, no, you go first. Let me see if you'll drown. If not, I'll follow. So essentially, that's it. From when you have blended finance or first loss positions, essentially you tell the person who will come with the largest ticket size that I will take the hit first, right? For guarantees, we tell you, if that person does not pay you back, I'll pay you back. So you just give these extra assurances. And the reason these are necessary is we have talked about investor sensitization. So I'm not going to profile anyone, but if you look at pension funds or institutional capital, they don't really, because government crowds out the private sector in many ways, they don't really need to look at many of the projects that are put before them. That can be changed, hopefully it will, by maybe a reduction in the rate or what have you. If you look at banks, I won't say they're crippled, but their requirements on risk-weighted assets and core capital considerations kind of stop them from investing in projects that otherwise should be bankable, because maybe they need some collateral or they need to defray some risk on their balance sheet. So that's where you need these crowdsourcing tools to come in.
Okay, let me go back to Caroline. Now, Caroline, we had said ESG has moved from a reputational issue to an investment issue. Now, if a building is sustainable, in your experience, does it attract, or rather, let me not say attract, does it influence whether it's occupancy, whether it's operating costs, demand, value? Is a green building more valuable than a non-green building, and so on? In fact, simply put, is there a green premium? Does it exist, or is it an illusion?
Thank you for that question. And to answer that, let's first all agree that with the current generation and with the current information out there, we are all becoming aware of what ESG is and what value it will add to me. So first of all, if a building is green or it is green, it is making my experience to stay there comfortable. Just imagine if we're in this room and we're all sweating, trying to get aeration and all. But this building is green, we're able to get clean air, we're able to listen in and stay here. I'll be willing to pay even a higher price compared to a conventional building that won't give me the same comfortability that I'm getting here. So in terms of demand and occupancy, in most cases and in researches that have been done so far from EY, we've identified that for sure, if a building is green and the occupants there or the target market are aware of the ESG, their own ESG targets and their own ESG requirements, then they are willing to pay whatever price, but for their own comfortability. So in terms of demand, yes, but for eco-cautious, again, customers and tenants.
Okay, so the answer is yes.
Yes.
Okay.
Can go to operational costs. Like I mentioned earlier, so I was just talking to someone over lunch hour. I don't want to mention the company, but he was showing me their financial statements, and there was a whole bit on sustainability, and he was telling me they did solar panels in their building. And in 4 months, they have already reaped the capex that they input to install the solar panels. And in terms of energy savings and operational costs on that area, they were able to reap a whole 40% in terms of savings, in terms of operational costs. So yes, it is possible to get savings on operational costs.
Now, so I'm going to, before I go into a final lightning round, now I want to ask our CPA friend Elvis, and we can keep this a bit brief, but in this accounting conversation, who actually owns this, this reporting line, okay? Because in an organization, you may have people who are doing sustainability, you have your finance teams, you have operations teams, you have the board. Who owns the numbers, who owns the narrative, and who is accountable under that?
Yep. I think
S1, S2.
Yeah. So, first of all, these standards are what we call professional agnostic standards, meaning you don't have to be an accountant to understand IFRS S1 and S2. So it's just that they came through a familiar route, and that's accounting, because accountants have, for a long time, had IFRS accounting standards, which really just underpin what markets rely on in terms of decision-making through the financial statements that are published. So it came through a familiar route, but really, if you strip out the noise, everyone should understand sustainability reporting based on these standards. But more granular, if you get into under the hood and ask who actually does what, I think that would vary from organization to organization. But ultimately, first of all, the board is accountable for any reporting that happens, including sustainability reporting. So the board has to own the kind of reporting that is required under these standards. Then, if you think about the mechanics, the day-to-day mechanics, sustainability reporting is about, it requires the rigor that we already give accounting in terms of data entry, data capture. There's someone who's seated every day thinking, capturing data, crunching data, and asking themselves questions around it. So you have your operations team, who would have some, for instance, if you're running a property, your ops team would probably have energy, waste, management, data, water, consumption. Your operations team would have that. So once your ops team captures this data, your finance team needs to now take this data. And for instance, when we talk about computing emissions, scope 1, scope 2, scope 3 emissions, then it's up to your finance team and your sustainability team to actually sit down using this data, this raw data from ops teams, and compute some of these required metrics that the standard requires of them. And then you also have your sustainability team within your company that puts all this narrative now together. The finance guys give the rigor to the data. The sustainability team flesh out the data to give a coherent story around these disclosures. So that's sort of how you can think about that information value chain and who gets information at what point and how it gets all the way to the board. But more importantly, once it gets to board level, does it actually influence strategy? Does it influence your risk management? And overall, are you improving in terms of tracking those metrics?
Okay. Okay, very good. So as we wind up, and I'm very conscious about the clock, because we want to do a very un-Kenyan thing and finish on time. So I'm going to go into a lightning round, and I'm going to ask you to answer this question very, very briefly. If you had to choose one intervention that would most accelerate sustainable REIT finance in the African market over the next 3 years, what would it be? Starting one intervention.
I think I would choose climate risk assessment of the REIT portfolio, that is the assets. And reason why I'm choosing climate risk assessment, I like I don't know if it's Elvis who mentioned about the recent floods that happened and the impact that they had on some properties. As an investor, or what investors are looking for in terms of the ESG and in terms of these assets is, what would go wrong if this shock happened in years to come or in the next 2 years? What would go wrong? And if it would happen, how resilient are our properties while this shock happens? At the same time, if this shock happens, can our properties still continue to perform? And can the property still generate, income, or can they still continue to perform? At the same time, I think that's what I really choose, but on an asset level. And that is very key. And there was someone here from Econ who mentioned about GRESB, the Green Real Estate Sustainability Benchmark, which emphasizes really on asset level climate risk assessment, not at a portfolio average, but at asset level, so that the investor can know which property is operating, which one needs improvement, and why property A, why not property B. And then you come now at the portfolio aspect. So for me, I would choose climate risk assessment data.
Okay. Josephine?
For me, I would choose capacity. Both project origination level, structuring level, and at the investor level as well. I'll keep it short.
I battled with this, but project preparation, I think, would be the first thing that needs to move. That would create a lot.
Okay. And finally, Elvis.
Yeah, I think for me, the thing, it needs to move from location to location efficiency resilience. That's the only way we can be able to unlock the kind of capital we're looking for.
Thank you very much. With 20 seconds to spare, I think that's we've come to the end of our panel discussion. I think we may have Mr. MC Gift. Do you have time for some questions?
Just because this is a Gen Z panel and you've kept it very precise on the time, actually in 4-5 seconds. Time up. Can you give them a clap?